Perfect. Okay. Hi.
How are you, Jordan?
I'm good. How are you?
I am great. I'm great. I'm glad to see you again and talk with you today.
Mhm. Perfect. First, I want to have you introduce yourself. So, name and job title, please.
Oh, absolutely. I'm Tim Kirby, and I'm a financial advisor with Edward Jones Investments. So I do financial planning, guidance on investing, and planning for in all manner of financial goals for people.
Perfect. Thank you. I would first like to ask a couple of questions about your experience in this job. So, how many years of experience have you had in this position?
In this position, I'm in my 10th year. Yeah, 10 years in this role.
Perfect. Um, what sort of education did you have, and what type of degree do you have, and where did you get it from?
So that's funny. It's a funny question because my original background, my undergraduate and graduate school degrees are not in anything to do with finance. So undergraduate was a double major, Bachelor of Arts in English literature, and then also in philosophy. And so that was my background. And then in my particular case, I thought I was going to go to law school, but I ended up going to seminary and training for the ministry. So I became a full-time minister. And so I have a master's of divinity and master's degree in pastoral care and theology. And then went on from there, transitioned to the career that I'm in now as a financial advisor. But in that role, um, various types of educational uh, experiences, I guess you could say. So, um, at the beginning with the preparation for securities exams. So, Series 7 General Securities Representative licensing, long process of study and preparation for a 6-hour exam that you sit for that. The Series 66, another securities examination that I had to pass. That was about a 4-hour exam there. I also have done advanced training as an accredited asset management specialist, some training designation exam there. I'm a chartered financial consultant. So if you've heard of CFP, it's the same thing, but has a little deeper, a little bit more actual training to it. Certified financial planning, so chartered financial consultant. I'm actually in the middle of another designation too, certified exit planning advisor, and it's to advise business owners on the transition and sale of their businesses. So that's been my background, and a lot of a few other things and ongoing education that's required as a part of this to stay current, keep your licenses current and things like that. Also, life and health. So life insurances, long-term care insurance, disability insurance, variable annuities of all types, those types of insurance products as well. I'm a licensed insurance agent as well.
Good, thank you. I wish you luck in your continued education.
Thank you
Um,
so much.
so I just have a few questions from both my teacher and from people that are around my age about like finances, anything that has to do with money, basically.
Yeah,
If you can't offer any advice, that's totally fine. Just say that that's not your area of expertise.
sure.
But I would like to first start off with a few questions from my professor, actually. Um, so her first question is, how many clients do you have, if you're allowed to say that?
Yeah, so I have about 175 households,
Mhm.
right? So several of those households, of course, are couples, or they have, they maybe there's more than one person in the household, but it's a good way to think about it. About 175 households
Okay.
that I oversee, and I try to not grow much beyond that on purpose. We do have some attrition and people that, different reasons, people pass away, things like that.
Mhm.
Um, but I try to manage it. And at this stage of the business, taking on fewer clients because I like to have I like to have enough time, sufficient time to really have a good touch and involvement with each client that at the level they deserve. So, but yeah, that's about the size of our what you might call our book of business.
Lovely. Her next question was, how young was your youngest client?
Yeah, how young was my youngest client? Um, well, it's a tricky question because in order for you to be so to enter into contracts, right, you have to be 18 years of age, right?
Mhm,
But at the same time, there are custodial accounts,
mhm,
right? So the type of account where a parent or some other type of guardian could set up an account that's in the name that is custodially held and managed by the person setting it up, by the parent, as it were. But yet everything that's in that account is actually it's irrevocably given over to the child, right? So I have several that are much younger in that sense, that they have custodial accounts that are being managed by their parents for them, but all that money belongs to them. So those can get set up really, immediately. Kids that are just born, some have had custodial accounts and college education accounts, 529, saving for college, things like that. I have a couple of clients who actually set up college 529 plans before they even had children, knowing they were going to have children. They wanted to go ahead and get started with savings, and as soon as their children were born, they assigned those to that child by name and social security number and all that. So it can start very, very young.
perfect. Um, Her next question is, are you a parent? And if so, how do you mentor your kids financially as a financial advisor?
Oh, that's a great question. Yes, I am a parent. I have one biological son who is now 26 years of age. I had three other children that we were foster parents for over time that are all in different home. Some have grown and have their own families now, and a couple others that were placed in families after this, but after being with us. Yeah, so for me in my family, the way that we always talked about money and things of value in that sense was that it is a gift that we're given, that we are managers of the resources that are in our lives, and that sort of hold on to it loosely but manage it well, understanding that money, that's not the most important thing in life, that there are much more important things in life, but yet we have a responsibility, which I would say God has given us, that he has given us resources, and that we have a responsibility on how we manage those resources, and to do it effectively, to do it with intelligence, to do it with skill and discipline, and so hopefully to grow those assets, and grow them not just for ourselves, but grow them to be able to be a help to other people in our lives, whether it be our own family, but hopefully even beyond that, people in need. So sort of understanding that God has provided to us and blessed us, so help us to be a blessing to others. So being a person of generosity is really important. As you become a person who gives, then you know how to hold on to things the right way. You recognize the value of things as a sort of a stewardship issue, a management issue, and then you'll increase your ability to help yourself, but certainly help others as well. So that was always sort of the foundational principle in our house, and it started with things like tithing, being able to give a tenth of everything that you receive, and then and also beyond that, things like that, principles like that help, I think, made sure that my son had a healthy relationship with money, with stuff. The relationship to your stuff is very, very important, and not to have an undue sort of dependence on stuff,
Mhm.
and to depend on things larger than that. So that's where it started. And we've talked about money principles, talked about not spending every dollar you have. Talk about having a strategy where you save for the future, those types of things, having those types of disciplines in your life. And so now my son, who is 26 and gainfully employed, has a very healthy savings account, investment account, invests and saves in his 401k at his job, and does all those things that makes me feel good as a parent, especially being a financial advisor, that he's doing this types of things that are going to set him up for the future.
Mhm. Good. All right. Next up, I have a few questions from friends of mine, people around my age, stuff like that. So these
Sure.
questions are kind of geared from teens, and I would like the answers to be geared towards teens or like young
Sure.
adult kind of thing.
Sure.
So the first question is, what are the best types of saving accounts for teens?
Yeah. So it sort of starts with goals, right? So what are the goals for the money that would be saved? If you're talking about short-term, intermediate goals, long-term goals. So if I picked longer-term goal, like retirement, for example, that's money that's going to be set aside and hopefully put in a position to grow over a long period of time, especially somebody who's younger, many, many years before they would need that money. It could be, 30 plus years before they would need that money. That's in that case, if they can do it, there's certainly retirement accounts that you can take advantage of, right? So different ones that they could use. A Roth IRA becomes a strategy that I think about, in that there are income limits, and if you are under a certain level of income, then and it's a pretty good number, a pretty high number, then you would be able to contribute to Roth IRA. And that Roth IRA, that individual retirement account, IRA stands for individual retirement account, but it's a Roth style. Money that goes into it after it's already been taxed. So it's money that comes out of your pay or whatever, however you earned that money, and then goes into the Roth IRA. But from that point on, it's invested in investments inside that Roth IRA. But from that point on, as it grows completely tax-free. And when you take that money out at retirement, then everything that you take out is tax-free, even what grew during the time that it was in those accounts. So always a great strategy. I love that type of strategy for anyone that can do it, but especially younger people. I think that the best advice I can give is that you do save and you recognize the ability of money to grow over time as you invest it, not just hold it as cash. Being able to invest it and see it grow over time. So there's a rule called the rule of 72. 72 is just a magic number. It's a Sesame Street number. I don't know. It's a funny number, but 72, the number 72 divided by a rate of return will tell you how many years that the money invested for that return will double before it doubles. So I'll give you an example. So 72 divided by 9 is 8, right? So that means that if you had an investment, let's say you had $50,000 and you invested it and you were earning a rate of 9% on average, sometimes it higher, sometimes lower, but if it was earning 9%, that $50,000, it would take 8 years, that $50,000 would be $100,000. And if you continue to earn at that same 9% rate, then in 8 more years, that $100,000, it would double again. It'd be $200,000. And in 8 more years, it'd be $400,000, and so on. So it's not exact, but it's pretty darn close if you do that math, 72 divided by the rate of return. And you can use different rates of return and figure out what your average, doubling might be. But the younger you are, part of the point of this discussion is that the younger you are, the more years you have for that doubling to take place, right? When you're older, you don't have as many years for that doubling to take place. And so you'll have to put more in to get to those larger numbers. But when you're younger, smaller amounts can really add up to huge numbers as time goes by.
Mhm. Yeah, thank you. And that kind of bleeds into the next question of what types of savings accounts. So like you mentioned Roth IRA, would you recommend anything else sort of like that?
So it if you have a limit for the amount that you can contribute to a Roth IRA in a given year, right? And it changes from year to year. And you can look up what those numbers are. 6,500 is a max in a year. It's not the minimum; it's the max you can contribute in a given year. And so once you do that, if you say, "Well, I want to save some more," just a regular brokerage account, it's a regular account that you can open, and you could still invest in different types of investment stocks, mutual funds, what have you. It's always a good strategy. The idea is just having the discipline of regularly saving, putting it away, and then investing it in something that's going to give you growth over time. Today you could do a savings account at the bank, but your return is maybe a little higher in a time like now where interest rates have pushed up, things like that, where you might get more on CDs and things like that than we have in the past. Problem is that's not a good long-term strategy. And so those rates will come back down. Having a longer-term strategy where you know that over time, the general trend of the market is growth. And just an example of the S&P 500, sort of one of the bigger indicators of the market, the overall stock market. The rate of return, historical rate of return for that's 11.82%, right? So if you were able to have invested there over its history, that's sort of the growth rate. So just having a strategy where you're not spending every dollar, you are saving, and then you're also putting at least some of that into investments that have a growth trajectory over time.
Mhm.
Have the money that you need cash wise for emergencies.
Mhm.
So that's a part of planning as well.
Mhm.
But so you figure out what's sufficient there. 3 to 6 months of expenses. If you're a single person, maybe up to 3 months. Up to 6 months. If you're a double wage earning family, I usually say 3 months because you have two incomes. But for an individual, younger, and you put away some cash. But then beyond that, begin to invest that, save it, and let it grow over time.
Perfect. You talked about not spending every single dollar that you would get. One of my friends actually asked if you had any tips on how to combat impulsive buying, like how to just take it back and not spend every dollar that you get, basically.
Yeah, I think one of the best ways is to not make it easy, like make it a little more difficult for you to get a hold of money,
Mhm.
right? You can still get it, but make it a little bit more challenging for you. Put some sort of steps in between you and the actual grabbing that money. The easiest possible way to spend money, the fastest way, the most sort of brainless way to spend money, if I might say, use the term, is a credit card, right? It's just so easy. Fantastic plastic, man. That's what I call it. You just keep sliding it. You have no idea exactly. You don't remember. You're not really keeping too good a track of what you're actually charging. You get the bill at the end of the 28-day period. You see what you charge, but it's really simple and easy. So I would say that credit cards are one of those things that are very, very it's a dangerous kind of a tool if it's not used in real discipline. I don't have anything against credit cards as a tool for quick access when you need it. It's good for emergencies.
Mhm.
It is good to also, at some level, when you're younger, beginning to build a credit history.
Mhm.
It's not a bad tool for that, but pay it off every month. All
Right.
right. Don't charge what you don't have in cash to pay. Right. And then each month when it comes in, pay that off. There's no sense in paying 19, 20, 26, 28% charge on that money. And first thing you know, you purchase some clothing, an item of clothing for $65, but actually you paid more like 87 or more dollars for it, really, when you have to add the interest that it costs you to sort of float that quick, loan with a credit card. So you're paying a lot more for everything when you let it accrue and not paid off every month than you would otherwise. So try to put your money in a place where it's not so easy to get to, and pay cash for everything that you can. Use a credit card only when you can't, and then pay that off each month. Those are some of the things I think are really, really important. And a lot of students are going to come out with debt already, maybe some student loan debt. So you're going to want to minimize any other kinds of debt that you have. Credit cards are much higher interest debt than student loans typically. So you're going to want to have a strategy for paying off those student loans. You certainly don't want to have be strapped with other revolving credit debt that has huge interest rates and just make it impossible at some points to even pay everything off.
Lovely, thank you. Another question that was asked was, what is the best short-term way for college students to handle money earned at a summer job?
Short-term money. So, well, like I said, I think it's important that you have a pretty good idea of what your monthly expenses are. Then have it set aside. So in the event that you can't work, you miss some time, or whatever the situation might be, you have that to draw from. I think that's really important. And having a checking and savings or savings account, those things are fine. Using the bank, that's absolutely fine for that type of money. If you wanted to do something where it's more intermediate term, looking at, like I said, CDs today, interest rates have pushed up. Those types of things could be okay. But know what your expenses are, plan for those expenses. Then beyond what you're going to have, consider that maybe more moderate or longer term, and invest that overage. But do it carefully. Do it as a part of an overall plan to make sure you have emergency funds covered. You're aware of expenses that are upcoming. Those things that you're going to need, and then start to invest the rest. Set some goals related to different things. Maybe the first goal that you might have is retirement, thinking about retirement, but also you might be looking to, at some point, when do I need to buy my first house? And it's okay to think about those types of things and already have in your mind sort of planning toward those things. You'll need some money for a down payment on a house, typically 20%. You can of the value of the house. There are a lot of first-time home buyer type incentives where you could maybe buy some houses with less, but I'd still think 20% is a good way to go, even if they don't require that. And save. That could be something you could save toward as sort of a intermediate term goal before retirement. So things like that. Begin to put your goals in place and just save toward them. And if you don't plan for it, it'll never happen.
I understand that. Another question that you kind of touched on, honestly, but somebody asked, what or how is the best way for teens to build credit and good credit?
Yeah. And so the simplest way is that credit card, right? And find those places where you can get a credit. Sometimes it might be a department store credit card as a way to get that first one going. Or maybe you find a general Visa or MasterCard or what have you. And they'll start with very low credit limits at first. That's because you just don't really have a credit history. So they're going to, low limits. But the real key to that is that you only, like I said before, you establish a record. This is how credit works. You start to show a record of paying your bills on time. It's a really, really important thing. So if you miss here and there, you're actually going to hurt your credit score. So you do get scored by those things, the amount of credit that you're able to handle, the history of your successfully paying those bills on time, not carrying huge balances that puts you more at risk. So I would say don't carry any balance and pay them off, but show a history of repeatedly paying those bills and paying them on time, not late. Those hit your credit report as well, and you begin to establish to the financial community out there that you're a responsible person, that you can be trusted, and then you'll see that your credit score goes up, and then you'll be granted more credit, right? So larger limits and things like that as you go. But it's a good way to begin if you're going to buy a new computer, or even if your parents are going to help you or something like that. Ask them to help you to get that in your name, and so that you, even if they helped you, at least you pay, it's in your name and you're paying that computer off, and you're building some credit history. And then once you have that credit card, you have that account, and maybe you're never going to use it again. That's okay. Leave it open. Mm-hmm. And even if you have that credit card and you cut it up and you don't even use it anymore, leave it open, because that is a part of your history, right? That will be a part of your file, and it's good for them to see, you've had this credit for a long, long time, and you don't have any balance for a long, long time, and that's part of your credit rating and your credit history.
Okay. Another thing that somebody asked was any tips on how to do taxes?
Doing taxes. Mm-hmm. For most young people, it's really not going to be very complicated. In a lot of cases, there might not even be, there's a minimal amount that you can make without even having to file. If you make a certain amount, though, if you do have substantial enough of an income, and there are numbers where it indicates when you need to file. In a lot of cases, probably I would say one of the online strategies, it can be just can do you well, because in other words, it might not be necessary to go to a certified public accountant, for example. Your situation would be so simple that the cost of doing that probably isn't warranted. It costs you more to do that. Likely following online, and maybe find out if your parents use a tax professional. Mm-hmm. Your parents, sometimes the CPA, the tax professional, could include your return at a pretty minimal cost, because they're doing the taxes for your parents as well. So that might be the one time that you would do that. You can do that, but probably an online, provider would be just fine in the simple returns that most young people would have. Okay, perfect. To kind of shift gears a little bit and ask about what you personally do. One of my friends had asked, how does a financial advisor track their investment performance? So investment performance for their own personal investments, or you mean for the clients? I think for the clients is what they meant. Got it. So, well, every single client has their own performance history and metrics and so forth. So every account and every investment inside of every account has the data that it's tracking about the original cost of the purchase of that investment, the value of it today, and the rate of return over time, mm-hmm. Starting from when it was purchased and so on. So all of that data, and if there are stocks, let's say, that are dividend mm-hmm. payers, right? So you own an individual stock that pays a dividend, That's just you as an investor getting some of the earnings the company is making shared back with you because you're an investor. That's what stock dividends are, just the earnings of the company shared with you based on the amount of shares you have. A lot of times those dividends are just reinvested back into more shares, fractional shares, to continue growing the amount of shares that you have. And all of that's tracked. All that information is there and goes into the basis of cost for that. And so we can track each individual investment. We'll track the portfolio of investments, so the group of investments as a whole and its performance. And there's reports that we generate for ourselves, but also for our clients. So, and there's also ways for the clients to see that online. They can see their personal rates of return and look into detail and so forth. So all that's tracked with a great degree of detail.
Perfect. I also wanted to ask, how would you go about teaching somebody how to invest in stocks? Or to invest in stocks?
Yeah, so I think that sort of the best way to think about stock is it's your part of as an owner. Like, so when you buy some stock, let's say you bought 100 shares of Pepsi stock, right? Pepsi's a big company and it's been around for over 100 years, right? If you buy some shares, purchase some shares of Pepsi stock, well, to the extent that you are an owner in those shares, you're a part owner in the company. So that's sort of what's happening. When they sell shares of stock, they're actually selling you part of the company. And you, along with a gazillion other people with Pepsi, are part owner in that company. And that's why when the company makes money, since you're an owner, you get some of it, some of the earnings and those dividends. So that's really what it is. It's your share of ownership in the company. Now, a company can do really well, a company can kind of stabilize, or a company can do poorly based on in terms of its sales, or maybe it's not managed correctly, or maybe it does really well, it has new products that bring in more earnings for the company, more revenue, and it goes well. The value of that stock, it could fluctuate up and down based on how that company is doing, right? And from the influence of its own inner workings and how it's managing things and how well it's doing as a company, but also there's influence, more outside influences from what the general market is doing, with what's happening in the economy, those types of things. So in other words, that thing that you own can rise and fall in its value, but because you own a company that has a value that's attached to it. So just know that it can rise and fall in value. And so there's a risk always, right? There's no such thing as riskless investing. There's a risk that you buy something that goes down in value. But over time, you look at good companies and you buy something that you think is going to go up in value over time. That's why you would, you buy an investment for you believe it's going to go, not just where it's been. It's good if it has a good track record of growth, but really it's about where it's going, and you buy it for its potential. And so that's what it is to buy an investment, and understanding that company. And then keeping an eye on that and see how it goes over time. And there may be a time to sell that investment. Maybe you sell that investment because it's not doing so well, or maybe you sell that investment because it's done so well over time that you've built up so much of it that now you've got an over concentration in that one company, and the risk of the loss becomes greater as you have this greater amount of money tied up in that company. So you need to diversify away from that, right? So reduce some of the risk by maybe selling some of those shares, maybe not all of it, selling some of that, maybe buying some other company to broaden your portfolio and reduce the risk. So hopefully that's helpful in terms of understanding a stock investment. You're actually an owner in that company, and you rise and fall with its value. And but until you've sold that investment, you haven't captured whatever has happened with the value of that, right? So if let's say you bought a share of stock for $50, it grows to 75, you've gained $25 in value. But if you still hold it, you haven't captured that $25 yet. If you sold it right then you would capture that $25. On the contrary, let's say you spent $50 per share of stock, it drops to 25.
Mhm.
If you sold that now, you would capture that loss of $25. But if you just held on to it, even if it dropped in value, you haven't lost anything yet. You still own the same amount of shares, but the value fluctuated. You could wait until it recovers or goes up. And I always encourage people to buy good companies and hold on to them for the long term because they will grow over time.
Mhm. I know that in the past we have talked about diversity of holding stocks, like having different companies and owning some of those stocks. I know that we've talked about that personally. I wanted to know if you could explain that a little bit
Yeah.
for people that are just getting into stocks or just thinking about buying some type of stock.
Yeah, it's a great question. It's really all about risk.
Mhm.
It's all about risk. It's important for any investor to understand what their threshold and their comfort level is with the fluctuations of the values of the investments they own. Some people just really don't like things to fluctuate. They have a very low tolerance. Others realize, well, things are going to fluctuate up and down. I don't mind that. I don't need the money right away. I don't mind that it fluctuates up and down over time. So it's really important to understand your risk tolerance. But also, it's important to understand your time horizon. How long between when you invest that money and when you're going to need it again? If it's a short term, you're not likely wanting to take much risk because you need it soon. If it's a long term, then you can probably take more risk, but still balanced with your comfort level with fluctuations, even if it's a long term investment. So managing risk is really important. Well, one of the ways to manage risk is to make sure that you don't have an old adage they talk about is having too many eggs in one basket, right? So that's the idea of spreading around your risk. So let me see if I can come up with a couple of examples. So let's say that you wanted to do just individual stocks. And let's say you wanted to put $100,000 into stocks. And you took that $100,000 and you put it into four companies. You put it into Pepsi, you put it into Johnson Johnson, and you put it into Jordan Incorporated, and then you put it into let's say Lowe's. All right, and those four companies, you own those four companies, and at some point down the road, one of those companies goes out of business. Let's say for some strange reason, Lowe's just doesn't make it, goes out of business. Well, now you've got $25,000, or let's say you've got 25% of your portfolio that suddenly is gone, right? Just suddenly. Now, that's a concentration of a lot of your money in a few companies. What if you took that same $100,000 and put it in, let's say, a mutual fund, for example? What's a mutual fund? Mutual fund is a collection of companies, and most mutual funds have 100 or more companies built into them. Okay. Now, what happens if you put $100,000 into a mutual fund that has 150 companies? Let's say one or two or three of those companies go out of business for some strange reason. Well, your money is spread around in so many companies that you're probably not real likely to feel it very much. The fund managers of that mutual fund will just replace it with some other better companies that can now begin to make money for the investors. So you're starting to spread around your money, reducing your risk by spreading out your investments. That's really a key part of investing properly, is that you diversify. You've heard about having a diversified portfolio of stocks and bonds. Let's talk about that for a minute. Mm-hmm. The example of stocks and mutual funds, I mainly was talking about what we call equities. Stocks are equities, but there are also bonds. Bonds are your more conservative part of your investment portfolio. So it's really important for most people to have a mix of stocks and a mix of bonds as well. That really does help to reduce the risk. fixed income investments don't fluctuate as much, nearly as much as stocks will. So having a percentage of your portfolio in bonds to help provide stability to it and some consistency of income generated in the portfolio, even though it not as over time doesn't earn as much as stocks will. It's good to have that stability, especially when stocks, values can fluctuate so much. This helps to even out the performance and the ride of the portfolio much better, reducing your overall risk and increasing the likelihood that you're going to actually reach your investment goals and get the return that you want. So that's at a pretty high level what I would say is the best way to think about understanding that there are risks, but dividing up your, diversifying away as it were, as a way to kind of think about it, your risk by investing across multiple accounts and types of assets. So that way you get to where you want to go, but in a safer way.
Perfect. I had a sort of personal question.
Sure.
I wanted to ask what your favorite concept is to teach to younger clients.
Wow. I mentioned the rule of 72, and I love that. I love to see, because I think when you start to realize that as a young person, you have a lot of years where your investments could just double and double and double. And I love to teach that concept and one of the things you can think about too is that investment that I mentioned, let's say it was earning 9%, that every 8 years it doubles. That's just a static investment. What if you're also adding to it, let's say on a monthly basis? Well, then your growth just is exponential. It continues to really grow. So when people really begin to understand that you don't have to do a lot every month, a little bit can happen every month, and you just doing that will give you amazing results over time. And if I had any regret personally, it'd be that I didn't start doing that earlier myself. That would be the best possible thing that I could have done. But you start from where you are. Everybody has to start kind of from where they are, right? And when they're able and when they're ready.
Lovely. Closing out, I just wanted to ask you if there was any other types of tips or concepts that you wanted to mention.
I'd say the first thing is don't think about it. Start doing something. All right, start doing something. You hear concepts like this, and you think that's a great idea. I really need to do that. I can see the benefit, but then you never get started, right? It's sort of like, I know that working out would be really beneficial for me. I know that getting stronger, getting fit, all those things, that's what I really need to do. And I'm going to do that starting tomorrow. So, and then it's always the next day. So I think the most important concept really here is understand that there is such a benefit. If there's one regret that I hear, and that I mentioned it a minute ago for myself, but if there's one regret that I hear from my clients, it's that, man, just imagine if I had started doing what I'm doing now many years ago. Where would I be today if I had just started earlier? So that's I think that's the most important advice I could give you and give young folks, young people. You might think, well, I'm in college and one of these days I'll deal with that. Or, I'm in my 20s and one of these days I'll look into the 401k plan for this new place where I'm getting a job. Don't do that. That's a mistake. That's a money mistake. Start younger and you'll have many more years of exponential growth. And I'm telling you, if you start young, you can retire younger too. Most of my clients wish they could retire younger than they do. And if you start younger in terms of your saving for that goal, you can retire at 55, 57, which right now for someone who's in their, under 20 or in their 20s, it sounds like that still sounds old, right? I get it. But believe me, when you get into your 50s and you start thinking about, well, man, what do I have another 15 years that I have to work? You like thinking about the ideas like, I really don't want to do that. I'd really like to be able to retire now. And if you start young, you can.
Perfect. Um, that's all the questions I have for today. Thank you so very much. This was very insightful and very helpful.
Oh, I hope so. It was my pleasure to do it, Jordan. And if there's anything else that you think of that comes up along the way, just let me know.
Of course. Thank you so much. Have a great rest of your day.
You too. You too. Take care.